Perfect. So welcome everybody. Sorry for the 2 minute go live. I don't want to call it intermission, but preamble to this. I'm sure you heard that every time we do these, I learn something new with technology. So to get things started, I am Mike Clark, and joining me is my colleague, as always, John Heck. I feel like a sports commentator right there for some reason. We are both with Avier Wealth Management and Advisors. Today, we're going to walk through one of the most misunderstood exit strategies in the business world, and that is the Deferred Sales Trust. And so our goal is by the time we wrap up today, you'll know what the structure is, how it works, what makes one defensible under IRS scrutiny, and what makes one fall apart in an audit, and whether or not a DST is a fit for your specific situation or whether it doesn't make sense. So we're going to get into all that here in a few minutes.
And before we dive in, first a little housekeeping. The Suits and the Bean Counters, as always, would like me to remind you that this session is for educational purposes only. It is not intended for specific tax, legal, or investment advice. Neither Mike nor myself are tax attorneys, trust attorneys, or CPAs. We are, in fact, wealth managers. Our role here is to coordinate the specialists who do this sort of work, not to be the specialists ourselves. And anything you hear today should be reviewed with your own qualified advisors before taking any actions. And one other important note, due to compliance requirements, we will not be taking live questions today during this session. At the end, however, we will show you 2 simple ways to follow up with us. So if you have any questions during the presentation, hold on to them, write them down, and we will handle it at the end.
Perfect. So here's what we're offering today. We're going to offer 2 goals. First, John and I want to teach you something that is generally useful about the structure of a DST and the things that I just described above, and why it's misunderstood and how it can be applicable in your life in terms of selling your business or a large asset. The second, and if we deliver on those goals, we're going to ask you to take one specific step. And it's not necessarily a trade for your time. There's no surprises, no obligations, but we do want to ask you schedule time with us, whether it's for yourself or for your clients, if you're a professional that works with clients, to actually learn how this can help you and your clients in their business needs, in their exit planning. So we'll get into all the details, but I want to start with a little example here just to kind of set some framework. So say you or your client, you're selling a business for $10 million. Let's just say the cost basis is $1 million. You have long-term capital gains or just capital gains. Let's just assume that that's 20%. Net investment income tax, some random taxes that are thrown in there, 3.8-ish. And then you've got your state capital gains tax somewhere between 5 and 13%, depending on where you live. So if you stack them all up, and once again, depending on the state and the type of that you live and the asset that you're selling, you're looking at roughly a $2.5 to a $3 million tax bill owed in the year of your sale. And that is the standard outcome, right? That is what most business owners are walking into. And so here's what we see happen almost every time is that owners spend 15, 20, 25 years building something real in terms of that asset or that real estate portfolio, and they make it to the finish line. And as the buyer is going through their due diligence, the business owner is sitting across from their CPA, if they have this conversation at all, and they hear the actual tax bill out loud for the first time. And they start to realize, wow, this is a real number they're going to owe. And there is nothing to do about it at that point, right? So what sits underneath that frustration is usually 4 specific beliefs. And I want to name them. I want to put them out on the table. I like validate them honestly, and then promise you that we'll address all 4 of them over the time that we have together today. So the first objection is, and I don't mean to pick on CPAs, but I always do this in all of our webinars. If this worked, my CPA would have told me about it. And that is a fair statement. It's a fair instinct. Here's what's actually going on, though. CPAs don't know about deferred sales trust because a small percentage of their business is working with business owners. On top of that, they are not attorneys. They wouldn't know where to start when it comes to structuring deferred sales trust, even if you ask them. So their purpose is to handle tax compliance. Strategy is a completely different job. And the strategy in the exit planning context, this is a small specialty niche within a small specialty niche. So your CPA might be excellent at filing taxes, but just by their nature, they tend to stay away from things like this. They just stay in their lane in terms of filing tax.
An objection two is, John, this sounds too good to be true. So we hear this one a lot. The truth is, this is not a loophole. As a matter of fact, there's no such thing as a tax loophole, but that's a conversation for a different day. The Deferred Sales Trust uses Section 453 of the Internal Revenue Code, which deals with installment sales rules. And these rules have been settled law for decades. The question is not whether the strategy is real. The strategy is real. The real question here is whether any given structure holds up under scrutiny. And that's where we're going to spend the bulk of our time today.
Okay, objection number 3. I've heard DSTs are aggressive or risky. And the truth is that some are, right? And the other side is obviously some aren't. The difference comes down to how they are built. And so hopefully by the end of this presentation, you'll have a framework, 3 specific tests that let you evaluate any DST conversation you have for the rest of your business owner life, right? To make sure it's the right fit. You will not be an expert. I just want to be very clear. You're not going to be an expert on this topic by the end of this conversation, but you will be able to ask the right questions.
And objection 4 is, this all sounds great, John, but I'm not selling my business for years. So this isn't really an urgent matter for me. And actually, this is exactly when the planning matters most. The window for getting your business ready to sell, that should have started the day that you opened your doors. Listen, when's the best time to plant a tree? The answer is 20 years ago, right? But if you didn't plant that tree 20 years ago, when's the next best time to plant that tree? The answer is today. So the same thing applies here. Learning the tools that are available to you to help keep more of your money, that starts today. So a deferred sales trust is simply one of those tools, and taking time to learn about the tools now will help make it easier for you to determine what tool best fits your situation when the time comes. Trying to do your due diligence on these tools after a letter of intent has already been signed, that forces you in many cases to rush through, which means you're more likely to miss very, very critical details.
And missing details is bad. And if this is the first time you're joining us, we do feel it's important for you to understand who it is that's talking to you and why we're here. So quick introductions. Once again, I am Mike Clark, the one on the left there. I spent the early part of my career on the investment banking side, about 42 million raised across deals before I moved into wealth management, this side of the business. And the reason I made that move, one of the main reasons that I made the move and why these webinars even exist is that the transaction is one moment. The financial life after it is decades long. And so most owners walk into a transaction with no one on their side of the table thinking past the closing date. So that is the work that we do now. We've said this in other webinars. We'll continue to say this in future webinars. We call it the financial quarterback role. We want to sit on the same side as you, same side as your client, and help deal with the coordination of these various specialists so you get the maximized outcome.
And for those of you who don't know, my name is John Heck. I'm also with Avior, and like Mike, I too am a wealth manager. For 35 years, I have I have been helping my clients acquire, protect, and transfer wealth. And I often tell people that I'm a terrible salesperson, but I'm a very good educator. In other words, translating complexity into a process that business owners can understand, follow, and act upon. My role is to translate what the tax code actually makes available to you in plain language with a clear process so you can make informed decisions. And I think it's very important to understand that myself or Mike, we're not here to replace your CPA. We are here to make sure that you and your CPA are getting the full picture.
Perfect. So now that compliance and introductions are out of the way, here is where most DST conversations go wrong from the start. The owner walks in believing that the question they should be asking is, does a DST work? Right? It's a simple binary question, yes or no. And every promoter that they talk to is incentivized to say yes. But I want to encourage you to kind of change that paradigm because the framing of that question is wrong. A DST is a single thing. It's a single tool. There are well-structured deferred sales trusts that hold up under IRS scrutiny, and there are poorly structured ones that fall apart in an audit. The difference between those two is the difference between keeping millions of dollars or owing the tax on that, plus penalties and interest depending on when the audit happens. So the right question is not, does a DST work? The question is, does this DST, as structured, satisfy the conditions the IRS expects?
And to help you answer that question, we're going to teach you a framework today. We call it the 3 pillars of a defensible DST. And those 3 pillars are structure, independence, and investment. Every DST that survives IRS scrutiny passes all 3 of these pillars. And every DST that fails in an audit has failed at least one of them. So by the end of today, you'll know what each pillar means, how to spot when one is missing, and what questions to ask anyone who proposes a DST to you.
Perfect. And before we walk through those pillars, I want to ask you one question. If we show you a structure that legitimately defers your capital gains tax or the capital gains tax of a client you're working with, and hand you a 3-part test to evaluate whether any specific DST conversation is on solid ground, are you willing to stay engaged in this time period, right? And I believe it's roughly 35 minutes. And so if the answer is yes, then we'll get into this. And the answer is no, then understand we're here every 2 weeks, different topic. But with all that said, let's set the stage of what a deferred sales trust actually solves. Let's compare that to the 3 options that most owners hear about first. So the first option when you go to sell a business is that you just take the cash at closing, right? John sells a business, I'm buying it, I cut him a check, and that's it. And then pay the tax that year. You lose 20 to 35% of your proceeds, depending on the state. And then this is the default option. This is the option that most businesses owners, if they sell a company, go with. And it's the most common path. And at 25 or 30% of the proceeds, it is the most expensive.
And option 2 is the 1031 exchange. This is often misunderstood. The 1031 exchange only applies to like-kind real estate transactions. It does not work for the sale of operating businesses. Even when the 1031 does apply to a particular transaction, there are elements to it, such as the 45-day identification window, a 180-day closing window, and these can be very restrictive to a transaction. So understand that the 1031 exchange is a tool with a very narrow use case.
The third option is opportunity or a qualified opportunity zone. And look, these require you to deploy the gain into a specifically qualified zone investment, which, by the way, is an illiquid investment. There are typically geographical restrictions to these, and the time frame, is a very long hold, typically 10 years ish, for the full benefit. So they're useful for the right investor, but once again, it's a very narrow tool.
And none of these three solves the core problem for most business owners, which is a large capital gain on the sale of the operating business. With proceeds, the owner wants to invest broadly, not lock into a specific real estate market or a zone. That's where the deferred sales trust fits very neatly.
But before we describe actually how a DST works, I want to address something kind of directly. So, and this is putting all the cards on the table here. If you Googled deferred sales trust, right, there's a lot of information about deferred sales trust, and you may have come across articles, or you will come across articles describing them as risky, aggressive, or even abusive. And here's what is happening behind those articles. So in 2023, the IRS designated something called a monetized installment sale as a listed transaction. That is the IRS's formal label for a structure that has been flagged as abusive or requiring disclosure on tax returns. Now, the IRS sees them as tax shelters. Some structures that have been sold under the label of deferred sales trusts are actually these monetized installment sales underneath the structure. So the same name to a layperson, but in reality, they're complete different structures underneath. And that conflation is the source of most of the negative coverage around DSTs.
So a properly built deferred sales trust is not a monetized installment sale. The difference is here structural, and we'll get into it in the next few minutes, but it's important to understand that distinction up front, because it's very important, because it means not every DST you hear about is the same thing.
So we're going to go into the main event here. We're going to go through 5 phases. First, the legal foundation. Second is how to properly structure DST, or how it works. We're going to go through 3-pillar framework. And then the fourth is the red flags publicly known to flag a DST. Actually, it wasn't the last, the fifth. We're going to talk about the real trade-offs that most DST conversations skip. And after all of that, we're going to run through a 5-question kind of self-assessment so you can leave today with a clear sense of whether this is worth a serious conversation for you or for your client, or whether it is not.
So let's start with the foundation. The deferred sales trusts operate under Section 453 of the Internal Revenue Code, and that's the section that deals with these installment sales rules. The rules have to be part of established tax law for decades, or they have been a part of established tax law for decades. They're not novel, they're not new, and it's not a gray area. But here's the core idea behind it. Under Section 453, if you sell an asset and receive payment over time rather than all at once, you recognize gain as you receive each payment, not at the moment of conception of the sale. That's it. That's the entire mechanism. The deferral comes from spreading the receipt of payment, and therefore the recognition of the gain across time.
Everything seems so easy, John, at a high level.
Yes.
Right? It's just that it's that simple. It's that simple. Right? But we want to be very clear is that the deferred sales trust is one specific way of structuring an installment sale. There are others, so you have to make sure that you find what fits you best. But the underlying mechanism is settled law.
Yes. So here are the 4 steps in the process. Step 1, the business owner sells their business asset to an independent third-party trust, not the buyer, not a vehicle that the owner controls, an independent trust. That's important. In exchange for those assets, the trust gives the owner a promissory note, and that note has a stated principal amount, a stated interest rate, a stated payment schedule, and the note here is a very real legal obligation. Step 2, the trust then sells those same assets within the trust to an actual buyer, and the trust is now the seller of record, and the buyer pays the trust, not the original owner. Step 3 is the trust takes the cash from the buyer and it invests that capital. Typically in a diversified portfolio managed by a financial professional, this is real investment activity. It is not parked cash. And step 4, the trust makes installment payments to the original owner per the note's payment schedule. The owner recognizes the capital gains on each payment as it's received, not on the original lump sum sales amount.
Perfect. So let's frame the benefit of step 4 clearly, because John, this is the second time John's mentioned this. Because the gain is recognized as each payment is received and not all at once at the sale, the tax liability is spread across the installment period. Now, that period can be many years. Most of them start off on a 10-year note, right? But meanwhile, the trust assets, which are the proceeds, are growing in the portfolio. So that is where both the deferral and the flexibility come from. So now the framework, the 3 pillars, that is the part we want to walk you through specifically today, because for a deferred sales trust to hold up under IRS scrutiny, 3 conditions must be satisfied, not one of them, but all 3 of them. So the trust must conduct a bona fide sale with economic substance. So real consideration must flow. Real transfer of ownership must occur. And the trust must actually own the assets between the moment it buys from the owner and the moment it sells to the buyer. Sells to the buyer. If the trust is a paper formality, if it's just a placeholder that exists so the sale can be relabeled, the structure does not hold up. And then the trustee cannot be the seller. And so it cannot be the seller's family. It cannot be the buyer. It cannot be an affiliate of any kind of either side. It cannot be anyone the seller controls. It has to be an independent individual.
And this is a very big or a very common point of failure for DSTs. You can look at the public tax court record on DST challenges, and the majority of them that fail turns on this pillar number 2, which is independence. The seller had too much influence over the trustee in those cases. The trust was not actually independent. And the IRS made the case that the seller never really gave up control of the assets. And the deferral structure, unfortunately, collapsed in those instances.
And then we mentioned this up above, the trust must function as a real investment entity, not a holding account.
So what this means is the trust has to actually invest the proceeds. There's active management involved. There's a real portfolio, real fiduciary stewardship. If the trust is just parking cash until the seller wants it back, the structure then starts to look like a deferred receipt of cash, excuse me, which is exactly what the constructive receipt doctrine prohibits.
So we've got 3 pillars. There's structure, independence, and investment. So without getting too aggressive here, memorize those in order is what I'm saying here. They are your evaluation tool for the rest of your business owner life. And whether that's owning real estate or any large asset, right? Anytime someone proposes a deferred sales trust to you, you have to ask the 3 questions. Is the sale structurally bona fide? Is the trustee actually independent? And is the trust functioning as a real investment entity? If all 3 answers are yes, the conversation can keep going. If the answer is no, the structure may be a problem today, tomorrow, 7 years, 10 years down the road, and that's something you don't want to have happen.
Now, let's talk about what the tax attorneys, the trust attorneys, the CPAs that we work with are looking for within these deferred sales trusts. And none of this is opinion, what I'm about to tell you. All of it is publicly documented in IRS materials or in the public tax court record. Red flag number 1 is constructive receipt. If the seller has direct or indirect access to the trust proceeds, the IRS treats the gain as already recognized at the time of the sale, regardless of what the paperwork says. So this is a functional doctrine the entire DST structure has to navigate. If you can pick up the phone and call, and call the trustee and pull money out at will, you have what's called constructive receipt, and unfortunately, you also have a tax bill.
So red flag number 2 is what would be considered a wraparound note from the buyer. And this is a structural signature of a monetized installment sale. And this is when a buyer's promissory note is functionally tied back to the seller. When the cash is effectively delivered at closing through a back channel that the IRS does not see as an installment sale. So they see this as a monetization scheme just to avoid taxation. And that is the structure that the IRS listed in 2023 as a listed transaction.
And red flag number 3 is a seller-controlled trustee. We just covered this in Pillar 2, but if the seller, the seller's family or anyone the seller controls is in a trustee role, the independence requirement fails and the deferral portion collapses.
And red flag number 4, a prearranged buyer where the trust has no meaningful role in the transaction. So the trust has to actually be the seller to the buyer, right? If the trust exists solely as a paperwork pass-through with the buyer already locked in and the trust providing zero discretion or value, the structure starts to fail the substance over form test.
And one more thing worth noting here is most deferred sales trust structures rely on private letter rulings the IRS issued to a specific taxpayer years ago. And for those of you who don't know, a private letter ruling is simply guidance that the IRS gives to a specific taxpayer in response to their specific question. It binds the IRS only to that one case. It's not an authority on all taxpayer questions. So when someone tells you that the IRS has quote unquote approved a deferred sales trust, what they actually mean is that the IRS has issued favorable private letter rulings to specific taxpayers in the past. Your deferred sales trust is not blessed by the IRS personally. It's built to comply with established law, of course, and the strength of that build is what matters.
And we want to be clear in saying these things is that none of this is meant to make you afraid of this strategy or any of the strategies that we'll present in the series. This structure is real. It is used successfully by many business owners over the decades, right? The point of expressing the red flags in this conversation is to give you the tools to tell the difference between a properly built DST and one that is going to collapse if it was ever audited. And so we want to make sure that we lay everything out on the table in terms of information. And so, with that comes kind of the trade-offs, because if you only hear the upside of any strategy, you're getting the promoter version of this, not the honest one. And the fact is because John and I are not an attorney, we're not trying to sell anything. We're just here to provide information so you can make the best educated decision. And so in doing that, the first trade-off is cost. A properly structured DST has setup fees. It has annual trustee fees. It has management fees on the trust portfolio. And for the structure to make economic sense, the tax deferral benefit has to be large enough to outweigh those costs. Now, that typically requires net proceeds of $2 million or more. And then for those smaller sales, you'll have to do the math and work with your advisors to see if it makes sense for your situation. But understand that if it's not right for your situation, there could be other options to minimize your tax liability. But one, you have to ask the right questions. And then two, you have to consult a tax attorney, your CPA, and advisors to find out what those are.
So trade-off number 2 is liquidity. You do not, with a deferred sales trust, you do not receive a lump sum at closing. You receive installment payments over time according to the note's schedule. If a personal cash need happens to arise over time, during the installment period, for example, a new home, a private investment, a family situation, whatever the case may be, the structure constrains your ability to deploy a large amount of cash immediately. And this is by design. This is a feature. It's not a glitch. The deferral works because the cash is in the trust, not in your personal account. But it is a real constraint, and it has to fit your personal situation. It has to make sense.
So trade-off number 3 is investment risk. And the proceeds in the trust are invested in a portfolio. And obviously, markets move. So the portfolio is subject to the same risks as any other diversified portfolio. The trust, I want to be clear, does not eliminate market risk. It just changes which entity is holding the assets while you wait for those deferral payments.
And trade-off number 4, and this one is important also because it is constantly oversold by DST promoters, and that is the step up in cost basis. You'll often hear that a DST allows your heirs to receive a step up in basis at your death, eliminating the deferred tax. Well, this is only partially correct. What can receive a step up is the promissory note itself, the contractual claim that you hold against the trust, for example. The trust assets generally do not get a step up in basis because they're not owned by you, they're owned by the trust. And that distinction matters a great deal. We see this step up benefit dramatically oversimplified in DST sales presentations. And the reality here is that it's far more nuanced, and it depends on careful structuring of the note and the trust itself. So do not sign a DST agreement based on a step up in cost basis promise that you haven't pressure tested with the right tax advisor.
So now the practical part. All right, we're going to run through 5 question of self-assessment kind of together. I'm going to ask you the questions and you're going to answer them on your own here. And so when I ask these, I want you to think about whether it's your situation, if you're watching this as a business owner, or if you work with clients, how you could answer this for them. So first question is are you or one of your clients looking at a sale of $2 million or more in net proceeds? Number 2, are you 2 months or more away from signing a letter of intent? Number 3, is your need for the sale proceeds primarily for income over time rather than a lump sum? And then number 4, is this assessment sale, is the asset sale of an operating business rather than a sale of a C Corp stock that might qualify QSBS Section 1202 exemption? Now, in all honesty, that is a question, but for the most part, there are very few Main Street businesses that are structured as a C Corp. So keep that in mind. Question 5, are you willing to weigh the structure setup and ongoing cost against the tax deferral benefit? And so think of that. Think of your clients. Think of your situation. Count up the yeses. If you answered yes 3 or more times, then a deferred sales trust is worth a serious conversation. And even at a conversation level, that doesn't mean it's a right fit for you. It just means the basic conditions are met for the structure to make sense and to be presented, right, to get more information. The flip side, if you answered yes to 2 or fewer, then the odds are the DST is probably not the right tool for your situation or your client's situation. And that is also useful information in our eyes because it saves you from being pitched a structure that just doesn't fit. So real quick, let's summarize kind of what we've covered, right? So a deferred sales trust is a structure that uses Section 453, it's installment sale rules, to defer capital gains tax over time. It works when 3 pillars hold true: the structure, the independence, and the investment. It fails when any pillar is missing. The most common failure point is the second pillar, which is the independence. It does have real costs and real liquidity trade-offs. The step up in basis that John talked about is real, but more nuanced than most promoters present. And the strategy works for a specific kind of business owner or individual that holds large assets. But the fitness check told you whether that might be that kind of transaction that could fit for you and or your client.
And one thing I want to underscore here is that this is a part of exit planning, and the opportunity for properly planning your exit is a finite period of time. It's open to you right now, perhaps, but the closer you get to your exit, voluntarily or involuntarily, the harder it is to optimize your exit. With such a large percentage of yours or your client's net worth tied to the business, obviously you want to optimize to the best of your ability, right? So we meet business owners pretty regularly who have sold their businesses already, but have never heard of a deferred sales trust. And that is unfortunate that their advisors never told them about it.
And this is why John and I are doing these webinars. Like, once again, we are not the practitioners. We do not structure DSTs ourselves. Our firm does not. We provide the information and then coordinate the specialists who do this specialty work. And so we want to make sure that we're sitting on your side of the table or the side of your clients, and to make sure that the questions are asked that you and or your client might not know to ask. And that coordination role, what we call the financial quarterback, is the reason that we exist. And if the DST might fit your situation, the next step is figuring out who needs to be at that table and what the right sequencing is in terms of that conversation. And that coordination, that work, is what we do every day. And on top of this session, or at the top of the session, like, I made you kind of a deal, right? 2 goals: teach you something generally useful, and not to be biased, but I think John and I did that, right? There's a lot of people that don't understand what this is, and obviously this is a very high level conversation, and there's way more once you get into the weeds, but starting the conversation and teaching you something is our goal. The second is, obviously, if we delivered on that, and you see this as a right fit, ask you to take the one specific next step, which is scheduling a call. And so there's 2 ways to do that. Both are super simple. Step 1, or the first one, is if you have any questions or anything that we covered today, or on any of the previous webinars, anything at all, send John or myself a direct message here on LinkedIn. If you're watching the recording on this, you can shoot us an email. It'll be in the description. But you also can put comments in the questions in the comments below. We will respond. We'll handle questions individually in writing for a specific reason, compliance. But it also lets us frame the answers carefully for your situation, right? To get it reviewed by the right specialist if needed, and give you something you can actually reference later. So if you have questions, message us. The second way to get a hold of us is, you see the QR code on there. That is to our calendar link. If you want to find out whether a DST or any other exit strategy might be a fit for your specific situation, I'd encourage you to book a value gap assessment by scanning that code. It's a 30-minute meeting. There's no cost, there's no obligation, but you'll have the information you need to make an educated decision. So, John, do me a favor. What happens during that value gap assessment call?
Great question, Mike. So on the value gap assessment, first thing we're going to do is we're going to listen to your situation, your timeline, your time horizon, what you've already considered, what you may have already have in place, what you don't have in place. We're going to walk through a fitness checklist as a series of questions with your actual numbers. What we want to do is we want to talk about whether a DST could be the right tool for you or not. And if it is, we'll describe the team that we would coordinate, the costs associated with that team, and what the next 90 days would look like. If it's not the right tool, if it's not a right fit for your situation, we'll tell you that as well. And we'll suggest what to look at instead. So the 30-minute call has zero cost and zero obligations either way. One last thing. The coordination piece in this work matters a great deal, more than most owners realize. The Deferred Sales Trust world has plenty of practitioners. What it does not have enough of is people who sit on the owner's side of the table, look at the whole picture, and quarterback the various specialists involved. So if you've already seen some of our other webinars in this particular series, you'll recall the importance of having a quarterback lead this team for you. And if you haven't seen them, I highly encourage you to check them out on our YouTube channel at Avior Wealth Management. So that's the role that Mike and I play in all of this. If that is something that you want at the table on your behalf, when you start your exit planning, the value gap assessment is where we recommend you begin.
John, I love the plug for the YouTube channel. You can also find them on our profiles. We post them all the time. So there's plenty of ways to get in touch with John and I. There's plenty of ways to get to watch the content that we've had. But this wraps up webinar 3 of 12. So certainly appreciate you spending the time with us today. The next webinar in 2 weeks, we're going to do a deep dive into asset protection in a very litigious world. And we're going to start asking questions. Is your personal wealth truly insulated? So look for that announcement here on LinkedIn later today. I'll be posting that. As John said, check out our YouTube channel. Look at the videos. If you have any questions about any of the topics, please reach out to us. Leave your comments below. We'll answer them. John, as always, thank you. I would say I'd see you in 2 weeks, but I'll probably talk to you later today.
Yes. Thank you.